Welcome to the deep dive. Today we are looking at a statistical reality that honestly should make anyone with a brokerage account or, even just a retirement fund completely stop dead in their tracks.
Yeah, it's a brutal reality check.
It really is.
Okay.
Because we live in this era of infinite open source data.
Right.
You basically have a supercomputer in your pocket.
Absolutely.
You get the exact same real-time financial information, the same earnings reports, the same global news feeds as the professionals on Wall Street.
Down to the millisecond, practically.
Exactly. So by all conventional logic, the playing field has literally never been more level.
But it's not.
No, it's not. Normal people keep losing money to the machines.
Yeah.
And it's getting worse.
It is a staggering disconnect. If you actually look at the data as of January 2024, and this is a mind-blowing stat, 91% of active funds trailed the S&P 500 over the previous 15 years.
Wait, 91%?
91%. Let that sink in. These are highly paid, highly educated professionals. Their sole job in life is to beat the most basic, boring benchmark in the world, and they completely fail.
That is just wild. When you try to visualize that, it's like this massive fork in the road. On one side, you have retail money, regular people, even actively managed human money.
Right.
And their returns are essentially flatlining or, actively decaying against inflation.
Yeah, they're drowning.
But then on the other side, you have the quantitative institutions, the purely mathematical funds. Their equity line doesn't just go up, it goes exponential.
It's a completely different trajectory.
So the natural question for the listener is, why? Because people still want to believe the market is a fair casino.
Oh, everyone wants to believe that.
Right. You want to believe that if you do your research, if you're smart, maybe you get a little bit of luck, you can win.
But that is the ultimate illusion. And what we are diving into today is how that illusion is maintained entirely by design.
By design. Wow.
Yes. The gap between retail investors and these quant institutions, it's not just a simple wealth gap. It is a structural exploitation mechanism.
A structural exploitation mechanism. That sounds heavy.
It is. Wall Street isn't out there trying to predict the future better than you are. They are building a trap.
Okay, that is a massive paradigm shift. Because, if you ask literally anyone on the street how a hedge fund makes billions, they'll just tell you they have better predictions.
Right, they think they know something secret.
Yeah, they think the funds know Apple is going to sell more iPhones next quarter, or they know oil prices are going to drop.
Exactly. The general public equates financial success with having a crystal ball.
Right.
But the hyper-elite quantitative funds, they do not care about the future of the company.
Wait, they don't care at all?
Not even a little bit. They do not care if a company cures a major disease or goes completely bankrupt. They only care about the plumbing of the market itself.
The plumbing.
Yes. They exploit the structure.
Okay, let's unpack that mechanism. Because this is where the real mechanics of Wall Street totally diverge from what they teach you in finance classes.
Completely diverge.
So the term everyone throws around is alpha, right? Meaning excess returns. The profit you make above the market average.
Right.
And people think alpha comes from picking a winner.
But it doesn't. In the quantitative world, alpha doesn't come from some magical insight into a company's fundamentals.
So where does it come from?
It comes from liquidity constraints. It comes from funding limits. And most importantly, it comes from entirely predictable, forced flows of capital.
Okay, let me picture this. I'm imagining a massive global funnel.
Okay, a funnel. I like that.
Right, so at the very top of the funnel, you have retail investors, day traders, maybe traditional mutual fund managers.
There's humans.
The humans.
Yeah.
And they are trading on emotion, buying on news rumors, selling in moments of panic. It's totally chaotic up there.
Complete noise.
But as that money drops down through the funnel, it passes through these rigid mathematical filters.
Precisely. It passes through risk limits, institutional liquidity requirements, structural mandates, all these rules.
And waiting at the very bottom of that funnel, the cold, calculating algorithms of the quant funds.
Yes. They aren't predicting anything. They are just catching the drops.
So let's give the listener a really concrete, visceral example of how this structural exploitation actually works in real life.
Sure. Let's talk about index rebalancing.
Oh, perfect. I think everyone remembers when Tesla was finally added to the S&P 500.
Yes, that is the absolutely perfect example of a predictable capital flow.
How so?
When a massive company like Tesla gets added to a major index like the S&P 500, the rules of the financial universe temporarily change.
Because of the passive funds, right? The retirement accounts.
Exactly. Passive index funds, which hold literally trillions of dollars of global retirement money, have a strict legal mandate.
Meaning they don't have a choice.
Zero choice.
Mm-hmm.
If a stock is in the index, they must own it. And they must own it in exact proportion to its market weight.
Okay, so when the committee announces that Tesla is joining the index on, say, a specific Friday at 4:00 p.m.
Those passive funds are legally blind. They cannot look at the price.
Wow.
They cannot evaluate whether the stock is currently overvalued. They are obligated to buy tens of millions of shares at that exact moment, no matter what.
And the quants obviously know this is coming.
Of course they do. The index committee announces it weeks in advance. It is public knowledge.
So what do the algorithms do?
They don't analyze Tesla's car sales, I can tell you that.
Right.
They analyze the forced buying power of the passive funds. The quants buy the stock weeks early, slowly, quietly, absorbing all the available shares at a lower price.
So they're essentially walking into the movie theater, buying up all the snacks, and just waiting by the only door.
That's exactly it. And when that specific Friday arrives, the passive funds show up, completely desperate, mandated by law to buy millions of shares regardless of the cost.
And who is standing there ready to sell it to them at a massive, risk-free markup?
The quants. They harvest what we call the liquidity premium.
They just wait at the exit door.
Yes.
I mean, that's brilliant. But it's also terrifying, because it means they aren't actually smarter than the average investor in terms of business acumen.
No, they simply understand the rules of the game. And the rules dictate that the passive funds, which again are largely your retirement accounts, are the inevitable structural losers in that transaction.
Man. Which brings us perfectly to the core of what we are doing today. We are exploring a survival manual for this exact ecosystem.
Yes, we are.
We are diving deep into Giuseppe A. Paleologo's book, The Elements of Quantitative Investing.
Paleologo is a fascinating guy.
He really is. He was a top quantitative researcher at some of the most ruthless hedge funds in the world, right?
Yeah, he has been deep inside the belly of the beast. And he wrote this book to basically tear down the mystical alchemy of Wall Street.
It honestly reads like a punk rock survival manual for the financial apocalypse.
That's a great way to put it.
Like, it is absolutely not a get-rich-quick book. It doesn't tell you to buy real estate or hold dividend stocks.
No, not at all. He wrote it specifically for what he calls the punk quantitative researcher.
The punk quant.
Yeah. His core philosophy is brutal but necessary. He says, if you want to survive in a world ruled by perfect, emotionless machines, you have to fundamentally change your nature.
Meaning what, exactly?
You must abandon your gut feelings. Your human intuition about the market is not just useless, it is actively suicidal.
Wow. Suicidal.
Yes. You have to rely entirely on matrices, probability theory, and cold risk models.
You essentially have to start thinking like a machine yourself.
Exactly.
But to do that, to even begin to adopt that mindset, we have to destroy one of the biggest lies taught in basically every introductory economics 101 class in the world.
Oh, yes. We have to talk about the lie of the average.
The textbooks literally lie to you. They tell you that the average return is something you can actually build a life around.
Yeah. If you open a standard finance textbook, it models asset returns as a perfect, smooth bell curve, a Gaussian distribution.
Right, everyone can picture that perfect, smooth, symmetrical curve.
It looks beautiful on a chalkboard.
It feels safe. It tells you that most days the market will move a tiny bit up or maybe a tiny bit down. And the really extreme events, they're pushed all the way out to the microscopic edges of the curve.
We'll take that smooth, safe curve and throw it straight in the trash because it is a deadly fiction.
Okay, explain the math behind that. Why is it so dangerous for a normal person to believe in the bell curve?
Because if the global financial markets actually operated on a perfect Gaussian bell curve, the math literally dictates that a major financial crisis, like an 8 standard deviation event, would almost never happen.
Wait, how rare are we talking? Like once a century?
Oh, way rarer. If the bell curve were true, a catastrophic market crash would happen maybe once every tens of thousands of years, or even millions of years.
Millions of years. But we literally have market-shattering crashes every single decade. Look at 1987, 2000, 2008, 2020.
Exactly. The real world does not fit the curve. The real world has what quantitative analysts call fat tails.
Okay, let's break down that term for the listener. Fat tails. What does that actually look like?
Imagine you take the real historical data of the stock market, every chaotic day, every crash, every boom, and you try to draw a curve over it.
Okay.
The middle of the curve might look somewhat normal, but the edges, the tails of the curve where the extreme events live, are incredibly thick. They are fat.
So there's way more mass at the extremes.
Yes, it means that catastrophic extreme events happen exponentially more often than the neat textbook math says they should.
And it's not just that they happen more often, right? It's how they happen. Volatility clustering.
Spot on. In the real world, big swings follow big swings. Calm periods follow calm periods. Fear breeds fear.
So let's bring this back to the listener. When a retail investor sits down with a financial advisor and builds a retirement portfolio based on, say, an average annual return of 7%, what are they actually doing?
They are essentially setting up a family picnic on top of a hidden trapdoor.
A trapdoor. That is a terrifying image.
But it's true, because they are planning their entire life around an average that doesn't actually exist in the day-to-day reality of the market.
Right. They trust mean reversion, the idea that if the market drops 30% today, it'll just naturally bounce back to its historical average tomorrow.
But the fat tail event does not care about the average.
Nope.
Extreme market flips wipe out middle-class wealth instantly because the human brain is wired to expect the normal.
The real world never plays by the average. If you plan for the average, the fat tails will literally slaughter your portfolio.
Exactly.
Okay, this sounds incredibly bleak, I'm not going to lie.
It's just math.
Right, but if we can't trust the average, and if these fat tail crashes are happening way more often than we think, but we can't predict exactly when they will happen, what do? Are we just sitting here waiting for the trapdoor to open?
No, absolutely not. This is where the brilliant shift in quantitative logic happens.
Okay.
We stop trying to predict the future. We don't try to predict the crash. We track the ghost.
Tracking the ghost of volatility. This was honestly one of the most mind-bending concepts in Paleologo's whole book.
It's genius. To do this, quants use very specific mathematical models. You'll hear terms like exponentially weighted moving averages, or EWMA, and state space models, like the Kalman filter.
Okay, let's act as a translator here for a second, because those terms sound incredibly intimidating.
Fair enough.
What is the actual mechanism at play? Like, what is a Kalman filter actually doing?
Think about the history of the Kalman filter. It wasn't even invented for finance. It was invented for aerospace.
Really? Like rockets?
Yes. During the Apollo missions, NASA had to track a rocket hurtling through space. But the radar measurements they were getting were incredibly noisy and delayed.
Right, lots of static.
The mathematical physics equations told them where the rocket should be. But reality is messy. So the Kalman filter is this algorithm that constantly, in real time, takes the noisy measurements and weights them against the historical predictions.
To do what?
To find the true state of the rocket.
It strips away the noise to find reality.
Exactly. Now, apply that exact same logic to the stock market.
Okay.
Algorithms literally do not care if a price is going up or down. They really don't.
Which is crazy because that's all humans care about.
Right. But the algorithms are entirely focused on tracking the underlying state of market panic.
Because of that volatility clustering we talked about earlier.
Yes. By using state space models, the algorithm looks at the noisy, chaotic trades happening millions of times a second. And it instantly calculates the current panic index of the global market.
It calculates the exact variance, the exact fear level.
Before a human brain can even process the headline on a Bloomberg terminal.
I love the analogy the book brings up here. It's not the volatility itself that kills you. It's your outdated perception of it.
Yes. What killed you is using yesterday's calm weather to judge today's hurricane.
It's like you look out the window on Tuesday, and it's sunny. So on Wednesday, you walk outside in a t-shirt, completely unaware that the atmospheric pressure just plummeted, and a Category 5 hurricane is actively ripping the roof off your house.
Perfect analogy. The machine knows the hurricane is here. Because of the Kalman filter, it updates its belief about the world instantly.
It detects the shift?
It detects the shift in the state space, realizes the environment is highly toxic, and cuts its risk to zero.
Wow. While the human investor just sits there, holding their stocks, waiting for the weather to revert to the average.
And the human dies financially.
Brutal. So, okay, algorithms are surviving the fat tails by dynamically tracking volatility. But that brings up another massive problem. how do these machines actually look at the whole market? There are tens of thousands of individual stocks trading globally.
Oh, right.
If you or I try to watch 10,000 moving tickers, our brains would literally melt. It's just a wall of static.
And contrary to popular belief, the machines don't try to process all 10,000 individually either.
They don't.
No, it is mathematically inefficient. Instead, they use a process called dimensionality reduction.
Okay, let's unpack this carefully, because this completely shatters how retail investors view the actual companies they own. How does a machine reduce the dimensions of the market?
They use factor models. They strip all the chaotic complexity away.
Give me a visual for that.
Okay, imagine you are looking at a massive digital screen, and there are 10,000 little dots buzzing around like angry bees. Total unpredictable chaos.
That's the global stock market.
Yes. But then the algorithm applies a mathematical filter, a massive loading matrix, and suddenly those 10,000 chaotic dots disappear.
And what is left on the screen?
A few dozen massive puppet strings.
Puppet strings. This is the exact moment where retail logic completely breaks down.
Completely.
A normal investor buys Apple stock because they love the new iPhone.
Right.
They look at the CEO, they look at the sleek design at the retail stores, and they think, I am investing in this specific company's vision.
They think they are buying an isolated asset.
Yes.
But the algorithm does not see Apple, it doesn't see iPhones, it doesn't see Steve Jobs' legacy, and it definitely doesn't see the glass retail stores.
But what does the algorithm actually see?
It sees a puppet, and that puppet is tightly controlled by a few invisible strings.
What are the strings?
String 1 might be the tech industry factor. String 2 is the U.S. macroeconomy factor. String 3 is the momentum factor. String 4 is large cap growth.
So the algorithm realizes that 90% of Apple's price movement has absolutely nothing to do with how good the new iPhone is.
Nothing at all. It is just being yanked up and down by these massive overarching macro strings.
That is wild.
The algorithm only cares about the strings. It trades the factors, not the stocks. It groups thousands of companies together based on their mathematical exposure to these factors.
The individual identity of the stock is completely irrelevant to the machine.
Irrelevant.
But wait. If everything is just a puppet on a string, then the genius returns that regular people think they are making
Are completely fake.
fake.
Your genius stock pick is a statistical illusion.
Ouch. You bought a tech stock, it went up 40%, and you're sitting there thinking, you're the next Warren Buffett.
But in reality, the tech string just got pulled up by macroeconomic forces. You aren't smart. The wind just happened to blow in your direction.
Face slap. Right there.
It hurts, but it's true. Which leads us directly to the holy grail of quantitative finance, the concept of alpha,
Right.
and specifically the difference between spanned alpha and orthogonal alpha.
Let's define these terms clearly, because this is where Paleologo gets incredibly precise about what actually constitutes a real edge in the market. Everyone wants alpha. Everyone wants returns that beat the market.
Everyone wants it. But the math proves a horrifying reality for most active managers. Most of what people proudly call alpha is just disguised risk.
Disguised risk.
Yes, it is spanned alpha.
Spanned meaning it is already covered by those puppet strings we just talked about.
Exactly. You present a strategy to a sovereign wealth fund. You show them incredible historical returns.
Look at my chart. It goes straight up.
Right. But when a real quant runs your portfolio through a factor model, they realize you don't actually have any special skill.
You're just taking on hidden risk.
You are heavily leveraged. You are taking on massive hidden exposure to one of those known factors, like the momentum factor or the illiquidity factor.
You're literally picking up pennies in front of a steamroller.
Exactly. You look like an absolute genius generating steady returns every single month, right up until the macro environment shifts and the steamroller flattens you.
So if spanned alpha is just taking on hidden risk, what is a real edge? What is true, undeniable quantitative skill?
Paleologo calls it orthogonal alpha.
Orthogonal alpha. It honestly sounds like a sci-fi weapon.
Well, it is the ultimate weapon in finance. In geometry, orthogonal means acting at right angles. Completely independent.
Right.
Orthogonal alpha is a pure microscopic pricing anomaly that is entirely statistically independent of all those macro puppet strings.
So, to use an analogy,
Yeah.
if the market factors are like these massive trade winds and ocean currents moving giant ships around,
Yeah.
orthogonal alpha is like finding a completely isolated, tiny microclimate inside a sealed box on one of those ships.
That is a brilliant way to picture it. It doesn't care about inflation. It doesn't care what the Federal Reserve does with interest rates.
It doesn't care about tech trends or global supply chains.
Not at all. It is a pure mathematical mispricing.
But the catch is, because it's so independent, it's usually tiny, barely visible to the naked eye.
It is microscopic. A human could never make a living trading it.
But when a supercomputer finds it,
When a machine finds it and mathematically scatters that tiny, pure edge across 10,000 stocks simultaneously,
the returns explode.
they compound exponentially with incredibly low volatility. That is what the top-tier quantitative funds are actually doing.
Wow, so if you are making money in the market without orthogonal alpha, you aren't a genius.
You are just standing on a fault line, enjoying the view, completely unaware that you are waiting for an earthquake.
Okay, but here is where the book takes a very dark turn.
Oh, it gets darker.
We talked about factor models. Value, momentum, growth. Those are factors that human economists created.
Right.
They make logical sense to the human brain.
Yes.
But what happens when the market goes completely insane?
Mm-hmm.
What happens during a severe liquidity crisis when the normal puppet springs get tangled and stop working?
When human logic fails, capital surrenders to the black box.
The black box. This is the realm of principal component analysis, PCA.
This is arguably the most philosophically terrifying part of modern finance.
Why terrifying?
Because, as you said, traditional factors make sense. We understand why value stocks behave a certain way, but sometimes the market becomes so chaotic, so hyper-correlated, that the old human rules completely break down.
So the quants just stop trying to apply human logic entirely. They unleash PCA.
PCA does not care about human logic. It is an algorithm that looks at the massive swirling cloud of raw market data, what we call the covariance matrix.
Okay, let's explain the covariance matrix simply. It's essentially a massive grid that measures how every single stock in the world moves in relation to every other stock, right?
Yes, it is a map of pure chaos. And PCA takes that map, and without any human intervention, without any preconceived notions of what tech or energy is, it extracts mathematically perfect patterns.
It finds hidden ghost factors.
Ghost factors, yes.
I really want to make sure you, the listener, hear this. The computer looks at the data, and it mathematically groups assets together based on statistical forces that literally have no name.
It finds the exact mathematical pathways of wealth redistribution.
Give me an example of what that looks like.
It might group a Japanese shipping company, a Brazilian utility stock, and an American semiconductor manufacturer into a single factor.
Just because the math says they're moving together.
Exactly.
But a human analyst would look at that grouping and say, that makes absolutely zero sense. There's no fundamental business connection between those three things.
The machine doesn't care. It trades the dose factor anyway, and it is terrifyingly accurate. It just prints money.
But here is the massive catch. If you walk onto the trading floor of a top quant fund and you ask the lead researcher why the machine just executed $1 billion trade across 50 random global assets,
They cannot tell you.
they don't know.
It is completely inexplicable in human language. The machine has found a truth in the data that is so highly dimensional it simply cannot be translated back into an English sentence.
Wait, think about the implications of that. If the machine cannot explain to the human why it's moving $1 billion, and the human just lets it happen because it makes money, hasn't the machine effectively taken over the pricing power of the world?
Yes, the machine has completely hijacked the global pricing mechanism.
That is chilling.
Human language, economic narratives, CNBC pundits arguing about earnings, it is all completely obsolete.
You're literally just along for the ride. The machine is driving a $1 billion bus in the pitch black using a statistical radar we cannot even perceive. And we are just sitting in the back hoping it doesn't crash.
Which brings us perfectly to the concept of the crash and the ultimate trap that quantitative analysts fall into, the Sharpe ratio.
Oh, the Sharpe ratio. In the world of finance, the Sharpe ratio is worshipped. It is the absolute holy grail.
It is. For those who don't know, the Sharpe ratio is a very simple mathematical concept. It is your returns divided by your volatility or your risk.
Right. So high returns with very low volatility gives you a really high Sharpe ratio.
Exactly. If you graph it, it looks like a beautiful, smooth line going up at a perfect 45-degree angle. No scary dips, just pure steady profit.
A high Sharpe ratio is the ultimate magnet for global capital. Like, if you can show a sovereign wealth fund or a massive pension fund a backtest with a high Sharpe, billions of dollars will flow into your fund instantly.
Because it looks safe. It looks like a sure thing.
But Paleologo points out that chasing the Sharpe ratio is actually a mathematical death trap.
It is. Traders are so desperate for that smooth line that they actually torture the historical data.
Torture it.
Yes. They will run a million different variations of a trading strategy on past data until they find the one combination of parameters that looks absolutely perfect.
But in doing so, they completely ignore a fatal mathematical law.
The curse of matrix inversion.
Okay, we need to carefully unpack matrix inversion and why it is a curse.
Yeah.
Because this is the mechanism that blows up so many so-called genius funds.
When quants build these perfect portfolios, they use a mathematical technique called mean variance optimization.
Right.
The goal is to mathematically find the exact perfect weight of every single stock to maximize returns and minimize risk.
Sounds great in theory.
To solve that equation, the math requires you to invert the covariance matrix we talked about earlier.
And what does inverting the matrix actually do in real terms?
It's basically a massive division problem. It takes your estimates of future risk and future return, and it calculates the perfect portfolio allocation.
Okay.
But here's the curse. Division by very small numbers creates massive volatility in the output.
Let me see if I can translate this to an analogy. It's like trying to balance a massive, heavy boulder on the exact tip of a needle.
That's a good visual.
If your calculation of the exact center of gravity is completely perfect, it balances perfectly.
But if your estimate of the future is wrong by even a microscopic fraction of a percent...
Which it always will be, because nobody can predict the future perfectly.
Exactly. If you have a tiny estimation error, the math of matrix inversion grabs that microscopic error and magnifies it hundreds of times over. It blows it up.
Because the optimization algorithm thinks it found a perfectly risk-free trade, so it levers up.
Yes. It takes that tiny miscalculation and turns it into a massive, highly leveraged bet on a completely doomed asset.
So the perfect strategy you found in your backtest is a complete lie.
You just oversit to the graveyard of history. You built a mathematical model that perfectly predicts the year 2018.
And when you turn that algorithm on in the real world with real money,
the performance crashes immediately, often by 50% or more on day one.
Instantly. The beautiful Sharpe ratio collapses.
Yeah.
The billions of dollars just vanish.
Greed blinds us to the math. Quants want the perfect line so badly that they completely ignore the fatal fragility of the optimization equation.
So if backtesting is so dangerous, and humans are so prone to tricking themselves with historical data, how do you prove you aren't just a lucky idiot?
That is the million-dollar question.
How do you prove you actually have a real strategy and aren't just a survivor of random statistical chance?
Paleologo introduces a hardcore mathematical protocol to solve this exact problem.
He calls it the Rademacher anti-serum.
Yeah.
I absolutely love this name. It sounds like a secret cure for a zombie virus in a sci-fi movie.
It essentially is a cure for the virus of fake data. As we said, traditional backtesting is full of cheating. It is plagued by data leakage.
Meaning researchers accidentally peek at the future while testing their models on the past?
Even subconsciously, yes. But the Rademacher anti-serum does not care about your feelings, your ego, or your narrative.
It is a cold, brutal mathematical test.
It measures the geometric complexity of your trading strategy. The more variables you tweak, the more rules you add to make your historical returns look good, the more complex your model becomes.
And the anti-serum punishes complexity.
Heavily. It takes a mathematical scalpel and slices off a massive chunk of your theoretical back-tested profit.
It applies a data snooping penalty.
Exactly. It basically looks at your strategy and says, I assume you cheated. I assume you tortured the data until it confessed. So I am going to proactively destroy 50% of your supposed edge right now.
It's like a ruthless bouncer at an exclusive nightclub.
Huh. Exactly.
You show up at the door with this shiny, perfectly polished fake ID of historical profits. They say, look, my backtest says I make 40% a year.
And the bouncer takes the ID, looks you dead in the eye, and snaps it in half.
The Rademacher anti-serum snaps your profits in half. It forces your mathematical model to prove its robustness under the harshest possible constraints.
And if your strategy still makes money after that brutal haircut,
only then do you have a real edge.
Only then do you have true orthogonal alpha. If you survive the cut of the anti-serum, then and only then are you allowed to trade with real capital.
It is the ultimate truth serum for quants. It kills the fake Sharpe ratios instantly.
It does. Now, let us shatter another massive, widely accepted illusion.
Bring it on.
The concept of diversification.
Oh, man. You've heard it a million times. Every financial advisor, every basic investing book tells you diversification is the only free lunch in finance.
Put your money in hundreds of different baskets, so if one drops, you are safe.
Right. But Paleologo argues that this is actually one of the most dangerous quotes you will ever hear.
Because spreading out risk mathematically works in a theoretical vacuum. Yes.
But let's look at the actual math used by quants.
Let's look at the information ratio equation. It breaks your overall return down into 3 distinct parts.
Okay, part 1 is your skill. Part 2 is multiplied by the square root of your diversification, meaning how many different independent bets you're making.
But it is the third part that destroys people, plus your position sizing ability.
The ability to know exactly how much money to put on a specific trade.
Blindly spreading your money across hundreds of stocks does not save you. If you are a bad trader, it actually accelerates your destruction.
Let's walk through the mechanics of that. How does that happen?
Imagine you only have 3 genuinely good investment ideas. You have real edge on 3 stocks. But you have been brainwashed by the free lunch quote, so you force yourself to diversify. You buy 50 stocks.
You just bought 47 bad ideas to dilute your 3 good ones.
Exactly. And it gets worse. Human psychology is terrible at position sizing.
If you lack the courage to bet heavy when you are actually right,
and you stubbornly hold massive heavy bags when you are wrong, because your ego won't let you sell a loser,
then your position sizing ability is a deeply negative mathematical value. You are financially bleeding to death.
Forced diversification doesn't dilute your risk. It dilutes your only remaining advantage.
There is no free lunch in the market. There is only the incredibly expensive cost of ignorance.
That is a perfect way to summarize it, which perfectly transitions to the topic of sizing and getting rich. We have to talk about the Kelly criterion.
Oh, the Kelly formula. It's legendary.
Developed at Bell Labs, originally used by gamblers in Las Vegas, and then fully adopted by Wall Street.
It is a mathematical formula that finds the exact optimal percentage of your bankroll to bet on a given edge.
It calculates the absolute maximum speed at which you can compound your wealth.
Right. If you know you have a 55% chance of winning, Kelly tells you exactly what fraction of your total money to push onto the table to grow your wealth faster than any other method.
It is the mathematically proven fastest way to get rich.
But there is a horrifying paradox hidden inside the formula.
The bankruptcy paradox.
The fastest way to get rich is also the fastest mathematical way to go completely bankrupt. How does that happen?
The formula for full Kelly betting, the absolute maximum optimal amount, assumes that your data is perfect.
It assumes your estimate of your own edge is flawless.
But we literally just spent the last 40 minutes proving that your data is never perfect. The world has fat tails, models overfit.
Exactly. So if you bet full Kelly and your real-world parameters are off by even a microscopic fraction of a single percent.
Maybe your win rate is 54% instead of 55%.
The aggressive leverage required by the Kelly formula violently turns against you.
It triggers a chain reaction, a total liquidation cascade, because you are betting so heavily, a tiny string of losses instantly wipes out your entire capital base.
You drop to zero. I want to quote Paleologo directly here, because this metaphor perfectly captures the mechanism. He says, pure Kelly is like vodka. Fractional Kelly is like Chardonnay.
It is a brilliant analogy. The Kelly criterion is pure, mathematically intoxicating leverage.
You cannot drink pure 100-proof vodka all night and expect to survive the party. Your system will literally shut down. You will die.
Greed is the perfect prey for mathematical laws. Human nature looks at the Kelly formula and sees maximum leverage and infinite wealth.
But the real world is messy, and the real world will shatter you if you run at maximum capacity.
Which brings us to how the machines actually handle fear. Drawdown management.
The smartest hedge funds in the world, the ones managing tens of billions of dollars, understand the Kelly paradox intimately.
They are terrified of their own fragility.
They know the math can turn on them in a millisecond, so how do they survive?
They never, ever run at 100% in capacity. They use something called time-varying fractional Kelly, or the Grossman-Zoo model.
And they actively, aggressively manage their drawdowns.
A drawdown is when your account value drops from its peak, right?
Nice. Imagine a fund hits a peak value of $1 billion. That is their high watermark.
If they take a loss and drop to $950 million, the human instinct is to double down, to get revenge on the market and win it back.
But the algorithm steps in.
The algorithm violently strips power away from the human managers.
Wow.
As the drawdown increases, the algorithm mathematically forces a smooth, rigid reduction in risk.
The human wants to bet bigger, but the algorithm forcibly cuts the bet size down.
And if they keep losing?
The algorithm ruthlessly cuts the risk down to absolute zero. They liquidate the portfolio and entirely they go to pure cash.
They just surrender. That sounds cowardly.
They don't do this because they are cowards. They do it because they are the only ones who truly understand the mathematics of complex systems.
In a giant, chaotic, fat-tailed system, surviving is everything.
Living to fight tomorrow is mathematically superior to chasing the last copper coin today.
Because you cannot compound to zero. If you blow up, if you hit total ruin, the game is over forever.
The machines enforce survival. Humans enforce greed. And that is exactly why the machine always wins.
Now we have one final invisible killer to discuss.
The ultimate friction of reality. Market impact.
Okay, let's set the stage for this one. You did all the math. You track the volatility ghost with your Kalman filter.
You used PCA to find orthogonal alpha.
You ran your strategy through the Rademacher anti-serum, and it survived.
You have the perfect trade.
You are ready to make millions. You deploy the capital, you touch the trade in the real world, and it immediately burns you.
Why? You literally did everything right.
Because of market impact. When quants build models, they often model the market as an infinite ocean of liquidity.
But it isn't.
No! When you actually execute a massive trade, you create a temporary shock, slippage, and permanent price impact.
We model this with complex equations like Almgren-Kris or Obaziva-Wang.
Let's translate those equations into a physical analogy, because this is crucial to understand why scaling a strategy often destroys it.
Imagine the market is a bathtub full of water.
Yeah.
The water level represents the current price of a stock.
Got it.
You find a tiny, microscopic mispricing, a coin at the bottom of the tub. You want to capture it, so you decide to quietly sneak into the bathtub to grab the coin.
But you are managing a billion-dollar fund. You weigh 500 pounds.
Right, so you step into the tiny bathtub.
And the water level violently rises.
But it rises entirely because of your own mass.
Your own massive buying order absorbs all the available shares and artificially pushes the price of the stock up before your trade is even finished executing.
It instantly incinerates your razor-thin profit margins.
The temporary shock of your entry destroys the very opportunity you were trying to capture.
And when you finally want to sell, you step out of the tub and the water level crashes.
Trading isn't just a simple game of buying low and selling high.
In the quantitative world, trading is a brutal exercise in calculating the fluid dynamics of your own massive body in a tiny pool of liquidity.
If you are too big, you crush the trade. The invisible tax of your own market footprint eats you completely alive.
We have just entirely dismantled the atomic structure of Wall Street.
We really did. We took the whole machine apart, piece by piece.
From tracking fear with state space models,
To extracting unnameable ghost factors with principal component analysis.
to cutting away human bias with a Rademacher penalty, and managing the fluid dynamics of market impact.
As we step back and look at this, we realize this was never a guide on how to pick a good stock.
No. This is the underlying physics of digital capital.
The quantitative algorithms are endlessly self-iterating. Computing power is expanding toward infinity.
The statistical models are becoming more complex, more alien, and more untranslatable to the human mind.
But despite all of that complexity, the core truth, the absolute physical law of the financial universe, never actually changes.
The structural exploitation of the uninformed by the hyper-informed.
The retail investor looks at the stock market and desperately searches for a narrative, a story about a good company they can believe in.
But the machine looks at the exact same market, ignores the story completely, and just looks for the mathematical trap.
The giant funnel we talked about at the very beginning remains intact.
Chaotic human emotion pours in at the top. Cold, mathematically purified alpha is extracted at the bottom.
So after pulling back the curtain on this terrifyingly flawless machine, we want to leave you with a chilling question to ponder.
As these cold, perfect codes take total control of the global markets, dictating prices without human language or logic.
Are we just witnessing the historical cycle of wealth inequality repeating itself?
Because throughout history, the people with the most advanced tools have always structurally extracted wealth from the people without them.
But this time is the extraction operating invisibly, flawlessly, and in a mathematical dimension that the human brain can no longer even perceive.